Hi, shop callers. Now seem like an excellent time to put up an education video on what short selling is. Many of you may have been watching or even participating in the Robinhood GameStop saga, where a David, Robinhood millennial clients, versus Goliath, the Wall Street behemoth hedge funds, versus also Robinhood itself, has been playing out in a bizarre life imitating art storyline that has seen the creation of unlikely bedfellows like AOC and Ted Cruz teaming up against the wolves of Wall Street. Stay tuned and subscribe to my YouTube channel for a deeper dive on the story coming in the next few days. Now on with the short show. The technical SEC Securities and Exchange Commission definition of a short stock sale is the sale of a stock where the seller does not own the stock. Most commonly, an investor thinks that a particular stock will go down in price, so they want to sell it high and buy it back low. This is what we would call a speculative trade. Say what? And not to mention why. First, the what. Step 1. In order to execute a short sale, an investor actually needs to borrow the shares from another investor. This is usually done via the investment firm the investor has an account with. This is called securities lending, and the broker will pay a fee to the person who lends his or her shares out for short selling. It's another way to add a little bit of income into your portfolio. Step 2, your broker is legally required to ask you to put up margin when initiating a short sale. The initial margin requirement is 50% of the proceeds you would accrue from shorting or selling that stock. Thus, if you sell 100 shares of a $10 stock, the total transaction would be $1,000. The initial legal margin requirement would be $500 that you would have to pledge into your account for that short sale. Step 3. Execute the trade where the borrower sells their shares into the market that they've just borrowed, hoping to buy them back at a lower point. If the stock goes up, then the short seller will have to continue to deposit cash to cover that 50% of the initial value, and even sometimes more if the brokerage firm sets a higher margin requirement. Risk. It is possible that the brokerage firm closes your short position if the original owner of the shares you borrowed from wants to sell them and the shares are hard to borrow. This is a risk with shares that might not be so liquid or readily tradable. The person who owns the shares has priority, and if they sell their shares, that trade must be allowed to settle as normal. Your broker will always try to find other shares for you to borrow, but it can happen, so that's a possibility. Step 4, hopefully profit. Let's say the stock you sold, let's call it Space Laser Firestarter, came out with the bad earnings and dropped from $10 a share to $5 a share. You might consider buying back the shares you sold to cover your short position. If you buy them back at $5 a share, your cost would be $500. You subtract that from the $1,000 you booked when you sold the shares in the beginning, and you would have a profit of $500. Step 4, the unlimited loss scenario. In this scenario, Space Laser Firestarter stock goes from $10 a share to $50 a share because there's a rumor that Elon Musk wants to buy the company. What just happened? Your broker calls you, emails you, texts you, sends you smoke signals to say you now have to top up your account with more money to meet the margin requirement of 50%. The 100 shares you sold are now worth $5,000. You must have at least $2,500 in the account to cover the 50% regulatory requirement. You already have $500 in the account, so now you must immediately pledge an additional $2,000 if you want to keep your short trade running. The other option is to buy the shares back at 50, so you do not run the risk of them going even higher. If you buy the shares back at 50, it will cost you $5,000 plus commission. Subtract the initial $1,000 you received from selling them at $10 a share, and you have a net loss of $4,500. Therefore, in theory, you have an unlimited loss potential when you sell a stock short. There are some risk mitigations that you can employ. There's something called a buy stop order, where you can enter a price to buy the shares back if they start going up to a point that you think that that's enough for you. This would be one way to limit your risk. Now, the why. We sort of discussed that a few minutes ago. To speculate on a stock going down. You can also short markets and other types of instruments, but today we'll just stick to talking about shorting a stock. There are quite a few debates on the ethical aspects of stock shorting. On the one hand, it allows for investors to have contrarian opinions on stock prices and to profit from those contrarian opinions if they're correct. On the other hand, if a stock has a lot of short trading and volatility, it can cause problems for that company, as we've seen with Robinhood brokerage. Some argue that short sellers can provide a reality check on stocks heading to irrationally exuberant levels. They can, but are not always a voice of reason. Poetically, the famous economist John Maynard Keynes famously said, "The markets can stay irrational longer than you can stay solvent." So there's that. From an institutional perspective, you have a very large hedge funds that will utilize shorting to remove some aspects of risk in their portfolios. For instance, they may do an exhaustive search on a sector in the market and find that they really don't want sector exposure within their fund. Sometimes if a sector has an issue, it can take the good baby right out with the bathwater. So they may, for instance, be long Microsoft because they believe Microsoft will dominate in the cloud computing space. But they may short other cloud computing companies so that if the sector falls, they are a bit hedged against the cloud computing space, although they're still keeping their position in Microsoft. There are many varieties on this long, short, or market neutral strategy. I simply want to give an example when they are not necessarily being speculative, but trying to hedge out a specific risk that they might think that they have. We'll dive a bit deeper into the trials and tribulations of the Robinhood and GameStop drama shortly and get further into the weeds, so to speak. The most important point is that you understand both the risks and rewards. Short selling is not easy. I leave you with a few statistics, mostly emphasizing that time in the market is the most important factor. The more time you have to invest, the more assurance you have of a positive outcome. A few stock market correction statistics to leave you with to put all of this in a little bit of perspective. On any given day, stocks have roughly a 53% chance of rising and 47% chance of falling. Over any given 3-month period, stocks rise 68% of the time, dropping the other 32% of the time. Over a typical 12-month period, the odds of making money in stocks rises to roughly 75%. If you're in the market for a long enough period of time, there's a 100% chance that you will experience temporary price declines. Fundamental discretionary traders account for only 10% of trading volume in stocks today. The other 90% is robotic, quantitative, and computer algorithms. Something else to think about. I hope you've enjoyed the brief overview on shorting stocks. Please like and subscribe so we can keep bringing you informative and relevant investment topics to help you on your path to becoming a savvy, confident, and successful investor.